All right, everyone, welcome back. Money Show is pleased to welcome Lynn Alden Schwartzer. She's the founder of Lynn Alden Investment Strategy and is a contributing analyst to ElliottWaveTrader.net, covering equities and alternative investments. With a background blending engineering and finance, Lynn blends fundamental research with a global macro overlay to find opportunities in the market around the world. Lynn, thank you so much for being here. It's all yours.
Hey, thanks for having me and welcome everyone. So what I want to talk about is something that's actually playing out in the markets over the past couple weeks, which is the duration risk. And so I originally set this presentation title up a couple weeks ago, and it's something I started writing about in mid-February, and now we're kind of seeing this play out. And so, if we look back in history, this overall stimulus effect was, of course, much different than the one from 2008 to 2014, in the sense that prior to then, most of the effort was on the monetary side, right? So we had a lot of monetary easing QE, and fiscal policy was relatively muted. And so what this chart shows is the year-over-year change in dollar terms, measured in the billions, of the monetary base, the broad money supply, M2, and government transfer payments. And so what we saw back then, during that 2008, 2014 period, was that we saw a sharp rise in the monetary base, but that mostly just recapitalized the banking system. It didn't get out into the broad money supply because there was no fiscal transmission mechanism. However, what we saw here in 2020 and then still continuing in 2021 is that that QE got directly into the broad money supply because the Treasury sent out checks to people, they issued bonds, and then a lot of those bonds were bought by the Federal Reserve with new base money. And so we've directly pushed up the broad money supply, which is a much stronger effect, more reflationary, and potentially outright inflationary. And so if you look back over the very long term, this chart shows the M2 per capita money supply with a rolling 5-year growth rate to factor out single year noise. And then the orange line there is a same thing for inflation as officially measured. So that's the 5-year rolling average. And what we're seeing overall is that there's historically a pretty strong correlation between broad money supply growth and inflation. And what we're starting to see, of course, is that broad money supply is picking up, and it's set to continue in 2021 as well, because we're going to get probably close to $2 trillion in stimulus, maybe a little bit less. We're getting about $1 trillion in QE as a base case. So we're looking at another 10 to 15% money supply growth, this year as well. So we're probably going to get up to the 50% year-over-year rolling average number. And so we're starting to put a lot of kind of inflationary pressure into the market to kind of offset the disinflationary trend we've been on for a while. And so this is presenting a lot of kind of important opportunities for rotating a portfolio, because the things that worked well over the past 5 to 10 years are unlikely to be the things that work out well over the next 5 years. And so basically the way this is starting to show up, of course, is that treasury yields are rising. And these are from a day or two ago. So they're actually higher today, especially after Powell's speech that he just gave. And so what we're starting to see is that the 10-year yield is picking up. It's still below inflation expectations. It's roughly in line with reported CPI at the moment. We're also seeing a bounce back in the yield curve. So that chart on the right there shows the 10-year yield minus the 3-month yield. And so this is all normal as part of a cyclical recovery, but it's also a more structural change, most likely, because the Fed intends to let this run hot. And so, we've been in a period where we've had, a declining for 10 years now, a declining spread between interest rates. We've been in a very disinflationary environment. And so that's very good for tech stock valuations, and it's pretty bad for value stocks, particularly banks, particularly energy. And so if we look back over the very long term, we have a moderate correlation between equity valuations and interest rates. And there were periods of exceptions. So it's not like if one follows, the other one has to follow exactly. But what we generally see is that the higher interest rates are, we then demand a higher expected return for our equities, which means we want to pay less for them. And so, for example, if you can buy a 5% yielding treasury, as you could for a big chunk of history, then you would demand a much higher equity total return expectation. And so you'd want to have a pretty big gap between, in order to take on that risk. However, when 10-year yields are down to 2% or 1% or less than 1% as they were for much of last year, investors are willing to lower their expected returns for equities and therefore pay up quite a bit of money for those equities. And so as we're seeing yields rise, we're starting to see pressures on valuations. And it doesn't affect all stocks equally. And so it basically, the longer the duration of the expected cash flows, the more that is impacted by the changing of the discount rate. And so what I mean by that is, this chart shows discounted cash flow analysis for a hypothetical company. The first year it earns $100,000, and then it grows at a 20% rate for 5 years, and then it's 15% the next 5 years, and then it's 10% for the 5 years after that, and so forth. And so both charts on either side are the same set of expected cash flows. However, one is discounted at an 8% discount rate, one is discounted at a 12% discount rate, which roughly means, we're pricing the one on the left as though we're expecting 8% returns, and the one on the right, we're expecting 12% returns. So we're being more choosy with our stocks. And so what we see over during that period is that if you value it with a lower discount rate, you can pay a price to free cash flow ratio of 46 times for such a high growth company and get away with it. However, if you then change the discount rate up just from 8% to 12%, well, then you're suddenly only willing to pay a price to free cash flow multiple of 29. And so that's a pretty significant valuation reduction for an otherwise good company. It's not that you're changing your growth expectations, you're not changing your expected cash flow in the future. You're just changing what you're willing to pay for those expected cash flows. And if you run these numbers for value stocks, which have lower valuations, slower growth rate, more of their cash is in the next several years, they're much less impacted by these changes in the discount rate. And so what we're seeing is that as rates rise, we're seeing growth stocks be far more impacted. And to show two examples here to make it more tangible, this is Apple. And what we see with the orange line and the blue line, that's the actual fundamentals of the company. So that's the earnings growth and roughly what the stock traded at historically. And the last couple of years there include analyst expectations. They roughly expected to continue doing what it has been. Whereas the market over the past, especially the last year, but also in the late part of 2019, really kind of doubled the valuation of Apple because the market started using it as a defensive store of value, almost a bond proxy. They said, okay, we're going into a pandemic. Interest rates are rock bottom. I don't really want to hold cash, but at the same time, I don't want to have exposure to cyclical equities. And so people just piled into tech. And Apple wasn't even the biggest rise, of course. That was just it's the largest stock in the index. But we actually saw an even bigger rise in many unprofitable tech stocks because they're even further spread out on the long duration spectrum. And so what we saw is that we completely decoupled the stock price from the fundamentals, mainly just due to the willingness to pay higher valuations at almost any price to get out of cyclical things and out of cash. But as we start to see yields rise, we're starting to see this kind of reverse. And on the other end of the side, you see this is Enterprise Products Partners. It's obviously less well known than Apple. It's one of the largest midstream businesses in the United States. So they transport a little bit of oil, but also natural gas and natural gas liquids, especially, and petrochemicals. So basically all the raw chemicals we use to make plastics and all sorts of polymers and pretty much everything we interact with in our daily life, along with natural gas and export terminals and things like that. And they, of course, took a really big hit in 2020 as energy declines reduced, but they were fundamentally strong. They're one of the least leveraged in the industry, one of the best managed. They didn't have to cut their distribution. They currently pay an 8% yield. At the bottom, it was well into the double digits. And so the market really panic sold these types of investments and kind of combined that with a narrative that Tesla is going to take over the world and that we're not going to have oil in a few years. But really, if you look at the full spectrum of what oil and gas are used for, including all the different petrochemicals we use, a lot of that was premature. And so now, of course, as yields are rising and as people are getting out of tech stocks, they're moving back into these more cyclical, more value-oriented equities. And so this is a business that pays an 8% yield, is slowly growing, and just well managed. And so they're comparing that, to something that is growing at a moderate rate, but that is extremely highly valued at 30 some times earnings for a company that's mostly growing through share buybacks and things like that, with rather, not super high revenue growth. And if we, expand this picture more broadly, this chart shows the value, the Russell 1000 value index over the Russell 1000 growth index, and its total return. So it includes dividends. And what this shows, whenever the line is going up, it means value as a factor is outperforming growth as a factor. And whenever it's going down, it means that growth is outperforming value. And these tend to change every cycle. Whatever market leaders led in the previous cycle are rarely the same leaders that lead in the next cycle. And so what we saw is that, roughly every recession, you have a switch in leadership. And we're starting to see that again play out now, whereas the big leaders over the past 10 years of this disinflationary environment, tighter yield spreads, kind of a bear market in commodities that lasted about 12 years. Everybody piled into tech at almost every valuation, and we're starting to see signs that is reversing now with higher yields and with kind of the shift towards more reflation and the potential for some substantial inflation in the years ahead. Now, there are a couple curveballs here that can prevent yields from rising too far. And so if you look back in the really long term in history, there's something called the long-term debt cycle, which is popularized by Ray Dalio, the founder of Bridgewater. And that's the idea that, it's debt cycles don't just go in these kind of short 5 to 10-year business cycles. They also build up into larger transition points. And so if you look back in history, this chart shows two different types of debt. The blue line is federal debt as a percentage of GDP, and it's the portion held by the public. And the orange line is non-federal debt as a percentage of GDP, which is mostly private debt, but also includes state and local governments because they're not monetary sovereign either. And so what this shows is that historically, a private debt bubble precedes a public debt bubble. And a private debt bubble is highly deflationary. And so we saw back in, of course, in the early 30s, you had that, the Great Depression, you had the 1929 crash, and you had a lot of bank failures. And that was eventually alleviated by a number of, policy responses, including the gold devaluation, which helped recapitalize banks, basically increase their reserves relative to their deposit liabilities. And then as you progressed into that decade, you started to see more and more federal spending. And then, of course, when in the early 1940s, when World War II popped up as an external threat, federal spending went into overdrive. They started racking up all this debt, and that created a ton of inflation. But then rather than let yields rise, they capped yields low because they couldn't pay high yields. You can't pay 5, 6, 7% treasury yields when federal debt to GDP is over 100%. It basically result in a fiscal spiral. And so what they did was they actually capped yields. So what this chart shows on the right there is that they held the 10-year treasury rate at almost exactly 2.5% for the entire decade, even as inflation was wild. Sometimes it would go up to 10% or more, and then it would fall back down, and then it would go up to another, at the very peak, it reached almost 20% in kind of an intra-year basis. And they just held the 10-year treasury rate at 2.5%. And the way they did that, the mechanism they used was buying bonds. And so basically they said, they had an open call out that if bonds trade, with a yield that starts to go above that level, they're willing to buy more and basically peg bonds at that rate. And so we saw from the early 40s to the mid 40s, the Federal Reserve increased their treasury holdings by about tenfold. And they had to over time rotate that composition to basically buy whatever parts of the treasury curve that the market didn't particularly want. And so that's kind of the curveball to be aware of, that, otherwise set to its devices, yields are likely set to rise for quite a while to deal with the fact that we have much more broad money supply, the potential for inflation, especially if we combine, supply shocks and the potential for, political changes about trying to reshore more of our manufacturing base and kind of end those disinflationary globalization efforts. If we start to normalize that a little bit, there are some substantial inflation risks over the next couple of years. And so it's going to be interesting to see how that plays out with all the different asset classes. And I think it's really going to more likely than not benefit the value side of the equity space for quite a while. Another way of looking at that long-term cycle is this chart, which shows basically a century of monetary policy and fiscal policy for the United States in one chart. And so we have three components here. The two lines are monetary policy. So you have short-term interest rates in orange, and then you have the monetary base as a percentage of GDP, which is in blue. And that can be either devaluing the dollar versus gold, which is what they did back then. And it also includes the Federal Reserve buying assets with new base money. And so what we saw back then is that, when you hit the zero bound, that's when you get an expansion of the monetary base. The Federal Reserve base has to pull out more unusual tools. And then even when that's not enough, that's when you start to see federal deficits go vertical, they absolutely skyrocket. And so we saw pretty big deficits in the 30s, pretty big deficits in the 2010s. But it wasn't until the 1940s when you had an external catalyst that deficits really got out of control. And the same thing here in the 2020s. Until we had this pandemic, we were kind of running at a moderately high deficit. When we had this external factor, we suddenly went into overdrive. And so in kind of an eerie way, the 2020s are mirroring the 1940s in a similar way that the 2010s mirrored the 1930s. And so it's something to be aware of as we position ourselves going deeper into this decade. And so there's basically, if you look out kind of across the world, right? So we've had a very US-centric view for the past decade because we've had this global disinflationary trend. Everyone piled into US growth tech stocks. And there hasn't been a lot of interest in value either in US markets or foreign markets. And so that's particularly hurt foreign equity markets because they tend on average to be more slanted towards value. And so whether that's Japan, whether that's Europe, whether that's most emerging markets outside of China, because China is pretty tech-based as well, but a lot of those other emerging markets, they're more slanted towards value. And so if we do get this ongoing reflationary, potentially inflationary, and higher yielding environment, that's where value has more of an opportunity to do well. And that includes financials, that includes energy, potentially includes healthcare and things like that. And so, for example, I've been covering one of the examples I've been using is the Japanese trading companies. And so these made headlines last year because Berkshire Hathaway bought several $1 billion worth of them. It was one of Buffett's biggest investments for 2020. And so this is an example of Mitsui Company. It's a Japanese trading company. They're a conglomerate that owns multiple different commodity exposures. They also have a variety of industrial and supply chain exposures. And as you can see, during that 2000s decade, they did exceptionally well. You had the ramp up in commodities. You had a very strong commodity bull market. That, of course, came with an emerging market boom and a good decade for industrialization. But then when that hit a peak right before the global financial crisis, you then had a 12-year bear market in commodities. And we literally in April of 2020, we went negative on oil. And Mitsui actually did surprisingly well. And the same is true for a lot of other Japanese trading companies. Of course, they had a rough decade because it wasn't a good decade to be a commodity and industrial business with such slow growth and a strong dollar and weak emerging markets. However, despite all those headwinds, they actually deleveraged their balance sheet considerably. They managed to keep raising their dividends, and they managed to hold their earnings roughly flat, flat and choppy for the decade. And so if they build a really strong base here, and I use Mitsui as one of the examples, but this is pretty much true if you look at all five of the top trading companies, that they have a really strong base to build on if we were to get another positive decade for commodities and put an end to this 12-year bear market in commodities, which is my base case if we get ongoing reflationary effects and large stimulus. And this chart here shows the deleveraging. This is the top 5 Japanese trading companies. Mitsui's there with the longest data points in orange. But as you can see, all of the Japanese trading companies have been deleveraging their balance sheets over the course of multiple decades from this giant Japanese bubble we had back in the 90s. And so if you look at overall corporate governance in Japan, it's really improved, and their value orientation gives them a pretty good positioning in my view, especially some of these more value-oriented companies within an overall value-oriented index. And so the broad Nikkei is one thing, but then when you really dive down into some of these specific value commodity-oriented financials, there's actually a lot of good things there. And the same is true if you look at other out-of-favor markets like Russia, potentially some places in Latin America. And so if you kind of have a more global view and a more value view, you could potentially do well in this decade. Although I think that some of the major equity indices, such as the S&P 500, that are very kind of highly valued and tilted towards these growth names, might struggle. And so that ends my core presentation. I'm happy to answer some questions.
All right, Len, thank you so much for that excellent presentation. We do had some viewers write in. One person, they're asking, what's your view on the fixed income bond portion of retirement portfolios in the rising rate environment? Should investors hold bonds at all or just hold cash for fixed portion of the portfolio?
So I'd be somewhat cautious with bonds. I think cash is a good hedge against volatility effects. And so if you were to get a sharp drawdown because, people the mantra last year was the stocks only go up, but of course we know that stocks can have considerable volatility. You can have hesitations in policy. We're seeing, for example, broad corrections recently, and so having some cash on hand to buy those corrections in equities that you feel are still in a strong bull market, I think is a good thing to hold. The bond portion is tricky. I do think that in some ways, a small allocation to gold can make sense for a portion of what might otherwise been bonds. Because if I go back to this yield curve control slide, if you get outright yield curve control, like let's say we get inflation runs hot, maybe in 2022, 2023, and bond yields start to get out of control, and if they turn to actual yield curve control, you could see gold go, vertical. Gold would have a really good time in that environment because gold mostly trades against real yields. And I actually have an extra gold slide here if I bring it up. So gold is strongly inversely correlated to real rates. And so right now we've had rates bottoming and moving up as nominal yields have increased. And so we've had this correction in gold. But if you were to get yield curve control, you'd likely get real yields way below -1%, and gold would have another big leg higher. And so my overall view is to have some cash for liquidity events and also have kind of a small strategic position to gold instead of a segment that might otherwise been in bonds.
All right, thank you so much. Another viewer here, they say some economists are saying that all the additional debt that has been issued will end up causing a deflation. What's your thoughts?
So it depends on the type of debt. And so if you look again at this slide that separates private debt from public debt. So this period in the 40s with all that debt, that was extremely inflationary. And that's because you're issuing debt, but you're not really drawing capital from the real economy because you're not borrowing from the economy, you're borrowing from the central bank that's creating new base money to buy it all. And so when you have these private debt bubbles, that's extremely deflationary, especially when they're unraveling. When you're unraveling and deleveraging a private debt bubble, that's a very disinflationary environment, and that's what we had in the 30s, and that's what we had again in the 2010s, starting in 2008. But now that we're moving on to very large fiscal expenditure, and then a large portion of that treasury issuance associated with that is bought by the central bank with new base money on the secondary market. That's a inflationary kind of policy response to that otherwise disinflationary outlook. And so my overall base case is that the rise in the public debt, particularly the portion that ends up on the Federal Reserve balance sheet, that's likely to have a more reflationary impact. And so, for example, if you look in 2020, people are often surprised at how well markets did and how well things bounced. But if you look at personal income, normally in recessions, personal income falls, which is what we'd expect from people losing their job and having their wages go flat or even get a wage cut. But in the United States, personal income went up in 2020 because the stimulus efforts were overall larger than the average income lost. And so we actually had, on average, national incomes went up. And so overall, and that's set to continue here with the next round of fiscal aid as well. So at least into the first half of 2021 here. And so overall, I think there's a lot of good reason to expect an uptick in inflation rather than a deflationary event.
All right, thank you so much. Another viewer, they're wondering, what are your recommendations for investors who fear missing out but have concerns on the high equity market and volatility to enter?
I think the main answer there is to have a global view. And so, for example, if you have enterprise products partners, I mean, that's not expensive by any metric. It's near the low end of its historic valuation range. And then when you go out to, foreign markets, you have companies like Mitsui. I mean, that company's trading below book value, and it's a profitable dividend payer with free cash flow, and it's using some extra cash flow to buy back its cheap shares below book value. And so, for example, I have a one of my stocks is Sberbank of Russia. They're doing exceptionally well, and they're trading at a single digit price to earnings ratio. Basically, anything outside of the U.S. tech centric thing and a couple of foreign tech is actually not that expensive because if you look at a lot of their charts, they've done poorly for the past 10 years, and it's just nobody wants to own banks, no one wants to own energy, nobody wants to own Russia, nobody wants to own Japan, nobody wants to own South America. Everyone wants to be in U.S. tech, and so I would be concerned about getting into U.S. tech, at least as an overweight position. I don't mind having a couple strategic bets in the U.S. tech, but basically I find that overall having a global focus and kind of pinpointing sectors and companies that are actually trading at historically cheap levels despite doing reasonably well fundamentally and that don't have any kind of obsolescence risk in the next 10 years is actually a pretty attractive place to be.
All right, excellent. Thank you. Another viewer here. Actually, we've had a few people touching on this topic. They're speaking in Bitcoin. They're wondering how it fits into an investor's portfolio, given what you've outlined here. And is it just another growth play, or could it actually hold value?
So we'll see. So I have a slide on Bitcoin here because I had a couple slides here in case questions come up. So I did a couple previous Money Show presentations over the past several months, and I've been recommending Bitcoin. I went long back in April 2020 for the first time, wrote a bunch of public articles of it in the summer and autumn of 2020, and that was back. I think you can see my cursor, but that was back here. I mean, Bitcoin was around about 7,000 when I entered, 9,000 to 10,000 when I was writing about it. Now we've had a really big move. Now, if you look at historically, people often try to correlate Bitcoin to several things, and the truth is really that it's mostly correlated to its own adoption cycle, similar to a tech stock. But in the near term, it can have short-term correlations. And so what this chart shows on the left is this is Bitcoin's price in logarithmic form. And these dots here are the halving cycles. And so every 4 years, the number of new Bitcoin generated is pre-programmed to get cut in half. And so it started out as 50 Bitcoins every 10 minutes. Then 4 years later, it was 25 Bitcoins every 10 minutes. And that keeps getting cut in half. We're currently at 6.25 Bitcoins every 10 minutes. And this will asymptotically approach 21 million Bitcoins. And what we generally see is that the 2 years after a halving event tend to be where all the bullishness happens for Bitcoin. And so that's one of the reasons I went long in mid 2020. And it really it decoupled from gold. It really kind of chased that tech stock theme. However, I mean, the last time it had a bull run was in 2017, and that was during a reflationary period of good global growth. And so it's not really correlated to any one thing. But of course, if you have liquidity problems in the market, if you have kind of shocks to different asset classes, it can be temporarily correlated to them. Like if you get a day where the dollar goes up and stocks go down, Bitcoin tends to go down too. But if you zoom out, it tends to follow its own adoption cycle. And so I'm still moderately bullish on Bitcoin throughout 2021, and then potentially further than that if you have a really long-term view on it, although it's less asymmetric than when I was recommending it last year.
All right, excellent. Thank you. Just have a couple of minutes here left. Another viewer, they're wondering, do you think the Fed will implement yield curve control? And if so, when?
So I do think there's a decent chance they will. I don't think it's soon though. And there are two countries currently doing it on a moderate basis, and those are Japan and Australia. And so they're not doing full yield curve control. They're not doing what the Fed did here in the 1940s, where they're literally capping the entire duration spectrum. Instead, they are like Australia, for example, is targeting the 3 year. They're just basically keeping the 3 year artificially low. And if you look at the full yield curve, it's really funny because the 3 year is like way lower than it should be, and everything else makes sense. And Japan, I forget exactly what I think they're targeting the 10 year. But they're basically targeting, I think, a couple points in their curve, particularly the 10-year. And they're having less of a problem defending it than Australia is. Australia has to buy a lot of bonds to do it. And so the Federal Reserve started talking about yield curve control back in late 2019. They published a paper on it in February 2020, which means they started working on it in 2019 before the pandemic. And so yield curve control is on their radar. They also started talking about it in their meeting minutes in 2020. They specifically cited what's happening in Australia and Japan, said they're watching it. And so it is one of the tools they have as an option. But I don't think they're going to be proactive in doing it. I think they'd only resort to yield curve control if they were to get a spike in yields. And I'm talking about a pretty disorderly spike. So the past couple weeks have been kind of a taste of that, but it would have to get pretty bad. Now, they have a couple tools they can turn to first. One is they can extend the SLR rules change for banks, which allows, is put into place last year. It expires at the end of this month. And that allows banks to hold more treasuries. And so if they don't extend that, they could potentially have another problem in the treasury market. Whereas if they extend it, it allows banks to hold more. They could also potentially do an operation twist where they sell some T-bills and buy some T-bonds to put pressure on the long end of the curve. And so they have some of these less extreme options. Yield curve control is kind of like their nuclear option. That's the one where they bring out when the other tools are no longer enough. And the reason they're hesitant to do it is because one is they're just completely manipulating the entire market at that point. It's like, everything else up till now is partially manipulating it, but that's just outright taking control of the market and saying your pricing doesn't matter. We're going to price it at whatever we want. And they also lose control of the size of their balance sheet because they have to buy as many T-bonds as necessary to maintain that peg. And so overall, I do think that yield curve control is an option as we move a couple years into the future, or even later this year if it gets really disorderly. But it's not something they'd pull out willingly. It's kind of like their trump card, their final play.
All right, and one last one just to wrap us up. What are your thoughts on Treasury inflation protected securities?
So I have a small allocation to tips. I think that they're one of the better parts of the Treasury market at this time. I prefer the shorter duration ones, and I basically use short-term tips as kind of a cash equivalent. And so that I kind of consider overall part of my dry powder. And they can do reasonably well, but again, the Fed can buy a lot of tips and therefore manipulate their real yields. And so I'd rather be in tips than say 20-year treasuries. But overall, if I do expect yield curve control, I want to be more in the commodity side of things. So basically, the way I've been playing it is that when we're not having yield curve control, we're getting steepening yield curve. I've been leaning pretty heavily into banks that really benefit from that steeper yield curve. But if you start showing signs more towards yield curve control, I'd want to be more in commodities and particularly gold.
All right. Well, we are speaking with Lynn Alden Schwartzer. Lynn, thank you so much for being here. I greatly appreciate a fantastic presentation today.
Yep. Thanks for having me. And thanks, everyone.
All right, and a big thank you to all of those in attendance. You are watching Money Show's virtual expo. Stick around, there's more great content on the way. Be sure to check out all the virtual booths in the virtual platform. And if you have any friends, family members that you would like to recommend our events to, please reach out to them. If you know any accredited investors, pass this info along to them. We greatly appreciate it. A big thank you to our sponsors as well for making these events happen. And you attendees, we couldn't have these without you. So thank you. Stick around. We'll be back with more content on the way.